Thank you all for coming here, and there's no place like Florida in the winter. I heard this afternoon that they had 2 feet of snow up north, and so I hope some of you were able to escape down here. What I'd like to talk about this evening is start off with a presentation on a quick 10-minute snippet on technical analysis. When traders come to conferences like this, and even if they don't, traders throughout the ages are always searching, looking at different systems, different ideas, new innovations that come along, and investigating the work of the forefathers of technical analysis. Always seeking not only new ideas, but just subtle little ways to constantly refine your own program or plan that you follow. And sometimes just one little tool or one little idea keeps it fresh and keeps you going and feeling inspired and motivated. So what I'd like to do is start off looking at what the basic principles of technical analysis are, and also 4 of the founding forefathers and the key concepts that they contributed. And this is important for a couple reasons. These guys sat there and did their work and their analysis in the early 1900s. You had a lot of volatility and interesting times going on, and you didn't have the advent of computers and research. So a lot of their observations are on changeless patterns that hold up in the markets today, and those tend to be the most durable and robust and most basic. And I have to say that when I started trading on the trading floor, it was like 19 years ago, and I feel like I myself have really only gotten into this area in the past 7 years and can really start to appreciate it, how important it can be in your trading and how it can simplify the structure of the markets for you. So I want to introduce just a little bit of the history and foundation of technical analysis that we have now. And then I want to spend some time talking about something that's very overlooked with some of these key forefathers. They were all great authors, great journalists, and great writers. And even though about half of their writing pertained to technical setups in the market, if you read between the lines and take the time to really study their work, I would say a good portion of what they wrote about also pertained to the psychological or the mental aspects of trading. And of course, people that are active in the market know that probably having the entry set up and the game plan is 10% of the game. And your ability to execute, to stay prepared on top of it mentally, is probably about 90% of it. And that comes down to simple things such as if you have a losing trade or you have a good trade, there's an aberration in the market's behavior, I would say that your success will be entirely dependent on your ability to move on to the next trade, to leave the trade that you've just closed out or just finished and move on to the next one and always be forward-looking. And this is a point that was brought up by these men too. So we'll touch on that, and then I want to tie the talk all together at the end. I better take off my watch right now so I don't end up speaking for 3 hours here. I want to tie the talk all together at the end with a simple little program in scalping S&Ps or day trading S&Ps. My program, some of the applications that I follow, that just tie in 3 or 4 of these very basic principles, and you'll see how it'll all start to fall together. It can be a little bit overwhelming with the software applications that we have when you start looking at all the fancy lines and stuff, and you've got to really understand the reasons why the market does what it does, or understand the concepts behind a certain pattern, in addition to just looking at the actual pattern. So I want to start off by just saying that technical analysis is based on 3 principles that you have to accept. And the first one is that the market is a discounting mechanism. You have to believe, if you are going to be a student of technical analysis, that every known piece of information out there is already priced into the market in some way, shape, or form. Because there are always interests with a lot more money than us, with much deeper pockets than us, with large commercial concerns that can afford to do the research, the study, be right on top of the latest statistics, the movement, etc. And they know this information. You have to assume, number one, that all this is priced into the market. It's a discounting mechanism. Number 2, you have to believe and you have to have faith that technical analysis is the study of mass psychology. It's crowd behavior. And that patterns will repeat themselves. And if you believe that there's constantly going to be a repetition of patterns because crowds behave the same way, not individuals, crowds do, then that too will give you that optimism that there can be discovered patterns in the market that will repeat themselves over and over, and this is how we can capitalize on them, make our profits on them. And the third thing that is important to understand is that markets either are consolidating or trending. Okay? A very simple concept. Once that a market is trending, the odds are that it will continue to trend. So these are the three basic premises on which this whole science is built, and it's really actually more of an art than a science. Now, of course, the forefather of technical analysis we all know of as Charles Dow. And Dow was an author, a journalist. He first started in 1880s writing down his observations. And he wrote a series of editorials and articles around 1901 through 1903 that comprised the foundation of his work. And it's really three other men that we can attribute to formalizing his work into a body of theories or principles. And these three men are Hamilton, Rhea, and Nelson. And each of them wrote books in their turn. So if you're a serious student of technical analysis, Samuel Nelson wrote a wonderful book called The ABCs of Stock Speculation. Rhea wrote and Hamilton wrote, and these would be important works to study. I have to repeat again, all these men are noting not only their technical observations on the markets, but they were all active traders too. Charles Dow was a trader, Schabacher, Wyckoff, Elliott, they all traded in the market, and so they do incorporate into their work, again, the constant mental aspects, if you read between the lines. So Dow started putting down his work in this session of editorials, which later was comprised into a more substantial body and named Dow Theory. The basic principles that Dow contributed still pertain today in numerous ways. The basic things that he noted was that there's always going to be three different movements in the market. The primary trend, the secondary trend, and the minor trend. And that's nothing more than saying, okay, you've got daily fluctuations, weekly fluctuations, and long four-year cycles. To this day, all the successful traders that I know tend to incorporate more than one time frame in their analysis. It's important to look at the hourlies in conjunction with the dailies, or the daily charts in conjunction with the weeklies, to get more of a three-dimensional picture of the overall structure of the market. It will make a difference in your trading in the long run, the more time frames you incorporate in doing your analysis. So Dow put that forth right in the beginning. The second thesis that he put forth is that the market will always move in action-reaction. Okay, well, that sounds like a pretty basic type of concept, you know. You're always hoping for that reaction when you're on the wrong side of it, right? And that's when you don't get that reaction. But as a general rule of thumb, the market's going to alternate back and forth in these types of waves or sequences. The next thing that he said is that the markets do tend to trend. And here's an interesting comment I have to share with you. I had been trading on the floor for a number of years and have been a trader for about 10 years. And I was a member of the Market Technicians Association. And finally, through the prompting of another buddy of mine, he's like, hey, let's go up and get our CMT test, which is this certification that you actually know what the technical analysis is. You know, I'm like, I've been a trader for, a number of years. I know that kind of stuff. Well, you start reading and you start to realize how little you know. And one of the questions they asked was, what is the definition of a trend in terms of classical technical analysis? And if somebody had asked me, it's like, well, the market's going up. Well, how do you define that the market is going up? Are you going to measure it by moving averages? Are you going to measure it by if it's broken through a channel? And Dow was the one who classically defined his trend as having a higher high and a higher low. You have to have both of those to define an uptrend, and a lower low and a lower high defines a downtrend. Once you have defined that sequence, then you can go on to extrapolate the odds favor, or the probabilities lie that that trend will continue. Maybe not 90% of the time, but then that would be where the odds would lie. And ultimately, in this game, that's all we're doing is quantifying probabilities. So Dow contributed, the